The job market in the United States is showing signs of strain, with only 22,000 new jobs added in August, a figure that raises eyebrows and suggests a potentially weakening economy. Historically, such a low number is often associated with the onset of a recession, starkly contrasting the previous norm of 200,000 jobs per month. Current trends indicate that job growth may stagnate, teetering around zero. Recent polling from the New York Fed reveals a troubling sentiment. Fewer than half of respondents believe they could secure a new job if they were to lose their current one. This growing unease underscores rising downside risks to employment, which could materialize rapidly through increased layoffs and an uptick in unemployment rates. In this context, the Federal Reserve plays a pivotal role. By adjusting the federal funds rate, the Fed aims to bolster business confidence in hiring amidst a landscape marked by trade tensions, immigration policy shifts, and inflationary pressures. Companies are exercising caution, weighing the potential impacts of tariffs on their profit margins. While they are navigating this uncertainty, their hiring strategies reflect a prudent approach, as they remain vigilant to the changing economic environment. As we look ahead, the implications of these trends on the labor market warrant close monitoring.
Result: in recent months, the job market has faced significant challenges, raising the question, why are jobs disappearing? The Federal Reserve's policies play a crucial role in this dynamic, but can they effectively reverse the trend? The slowdown in hiring has hit younger workers particularly hard, creating a strain on this demographic. Many firms are grappling with rising imported costs and struggling to attract talent in an environment characterized by high interest rates. Sectors such as technology, finance, and professional services, which traditionally hire a large number of younger individuals, are now under considerable pressure. Historically, recent college graduates have enjoyed better job prospects compared to the overall labor force, often experiencing lower unemployment rates. However, this trend has taken a turn since 2022. The U.S. economy has been navigating a series of rolling recessions, with various industries, including manufacturing and consumer goods, facing downturns that have not yet reflected in broader economic metrics. This situation has directly impacted youth employment, placing it in a precarious position. The high-paying information sector is also showing signs of distress. Software development roles for workers in their 20s have seen a notable decline since last year, and young marketing and sales managers are finding it increasingly difficult to secure positions. On a more positive note, younger workers are experiencing relatively swift job placements in the healthcare and retail sectors. As companies look to manage costs, many are turning to technology and artificial intelligence. This shift raises concerns about job replacement, particularly for entry-level positions that are simpler in nature. While a select few industries continue to add jobs such as healthcare and leisure, hospitality, there are indications that these sectors may also experience weakness in the coming months. Currently, less than half of the private sector is expanding its workforce, with manufacturing being a critical area of concern. Additionally, we are witnessing a slowdown in construction activity, a key indicator of reduced housing market activity. Businesses are adopting a more cautious approach regarding hiring, with some even implementing strategic layoffs. The Fed's interest rate policies are intertwined with the current labor market slowdown. These rates significantly influence job prospects for Americans and affect the pace of inflation. Lowering interest rates could potentially stimulate job growth, but may also lead to increased inflation. As we navigate this complex landscape, the outlook for the labor market remains uncertain. Raising them may mean less inflation and slower economic growth. The Fed took interest rates into restrictive territory in the first quarter of 2023. Since then, they've held the target for the federal funds rate high, relative to the so-called neutral interest rate of around 3%. In other words, the Fed's past decisions are restricting today's economic growth. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Historically, it's the case that as the Fed tightens and starts to contain inflationary pressures, that eventually puts downward pressure on the labor market. It was the case that June actually saw negative payrolls, which is the first time that's happened since December of 2020. I think the Fed is cutting from a place where it believes it has room to be wrong. Fed policy is best designed to address cyclical issues. If it's cyclical, the Fed over time should be able to nudge us back onto the path, but it can't change the path. Businesses that see lower interest rates could be motivated to hire more workers. A lot of it boils down to confidence. I'm gonna be facing relatively less restrictive interest rate policy. I can plan for that in the future and say, well, my burden here on the debt side is gonna go down a little bit. But my business is still relatively strong. I can take that extra risk and make that investment in an individual or in some kind of technology. Lower interest rates have many other effects too. For example, saving rates on bank deposits may fall. Financing costs for a mortgage or car loans could move lower as well, but only if Treasury bond yields follow the Fed. Long-term rates are incorporating a wider array of factors, which include a large budget deficit, which include trade policy uncertainty, and tariffs, which include higher inflation. And as a result, they're not moving as low, as the Fed funds rate is likely to move over the course of the next year. It's a highly political situation. It's totally rigged. Smart people know it. The slow pace of hiring is political trouble for the president. Experts say his policies could be contributing manufacturing or construction or trade and transportation. Those industries have been under the most pressure with hiring. Facts like that definitely point to the policy environment having a pretty serious and direct impact on labor. So it's not as much a monetary policy issue. But you could also argue that some monetary policy, easing and accommodation, could help at the margin for sure. Then there's immigration. Reduced immigration is curbing labor supply and reducing the so-called break-even rate, the rate at which the unemployment rate starts to increase. You could think that over time, domestic unemployed or native-born unemployed people could take the jobs of immigrants. Some of these jobs that are taken by immigrants are jobs that historically employers have found are not ones that are taken by native-born people. As the labor market deteriorates, prices are still increasing at a faster pace than the Fed's target rate. That makes an interest rate cut somewhat risky. Despite this, President Trump is pressuring the Fed to prop up the economy with lower interest rates. I really worry about the financial integrity of the Fed, much more than the financial integrity of the BLS. If we lose the institutional integrity of the Fed, we're gonna step back in a major way in terms of good economic outcomes. And let's not forget, we're coming off of an environment where inflation has been very high post-pandemic, and many people are still struggling to make ends meet. We also have to look at this in the context of an economy that is more supply shock driven. And when you have a more supply shock driven environment, you are just definitionally, the Federal Reserve or any central bank just has less power in being able to combat inflation and also being able to help the labor market. If the Fed is wrong here and it's cutting interest rates into an inflationary environment, then the impact could be negative for many people, in the sense that you would have higher inflation and that would really hurt a lot of people. The U.S. job market is very dynamic. The trouble right now is that tax policy, immigration policy, tariff policy are all in flux. And so it makes it very difficult for businesses to adjust. Once things settle down, if the government backs out and gets out of the way of the free market, U.S. companies should create the jobs for those who need them, ready to go unlimited, get immediate access to.